Imagine a time when the world's largest cryptocurrency exchange suddenly lost nearly $500 million in Bitcoin, leaving thousands of investors in financial ruin. This was the shocking reality in 2014, when Mt. Gox, once the dominant Bitcoin exchange, collapsed amid a combination of technical loopholes, poor security practices, and alleged mismanagement. Investors, developers, and early adopters watched in disbelief as hundreds of thousands of Bitcoins, worth over $450 million at the time, vanished without warning. Mt. Gox was trusted by the global crypto community, handling more than 70% of all Bitcoin transactions worldwide at its peak. Users believed their funds were secure, thinking that the platform's dominance and reputation made it nearly invulnerable. Yet, a critical flaw in the system allowed hackers and potentially insiders to exploit transaction mechanisms and withdrawal processes repeatedly, draining funds over time without immediate detection. The collapse of Mt. Gox sent shockwaves across the cryptocurrency ecosystem, shaking confidence and reminding the world that even the largest, seemingly most secure platforms were vulnerable to unforeseen risks. Today, we will explore the Mt. Gox loopholes, how they contributed to one of the most infamous cryptocurrency collapses in history, and the lessons every crypto participant must learn to avoid falling into a blockchain black hole. Mt. Gox, the rise of a Bitcoin giant. Mt. Gox was founded in 2010 in Tokyo as a trading platform for Bitcoin enthusiasts and quickly grew to become the world's largest exchange. At its height, it handled millions of transactions, facilitated the storage of thousands of Bitcoins, and became the hub for global crypto trading. Its rapid growth was fueled by early adoption, the excitement of digital currency, and the perceived security of the platform. Users from all over the world entrusted Mt. Gox with their digital wealth, believing that the exchange's infrastructure was reliable and that their investments were safe. The platform offered the convenience of trading Bitcoin for fiat currencies like the US dollar and Japanese yen, making cryptocurrency accessible to a wider audience. However, beneath this success lay deep vulnerabilities. Mt. Gox relied on outdated software, centralized storage of private keys, and weak internal auditing processes. The system lacked proper transaction monitoring, allowing subtle irregularities to go unnoticed for extended periods. These weaknesses created an environment where small errors could be repeatedly exploited, laying the foundation for what would become one of the most catastrophic financial disasters in cryptocurrency history. The platform's failure highlighted a critical lesson. Trust in technology is only as strong as its weakest code, and reliance on centralized mechanisms in a decentralized ecosystem can create catastrophic single points of failure. Understanding the loophole. The central flaw that precipitated Mt. Gox's downfall was a transaction loophole, often referred to as the malleability bug. This flaw allowed certain Bitcoin withdrawals to be processed multiple times without proper verification. Essentially, the system could be tricked into believing a transaction had not yet occurred, enabling repeated withdrawals of the same Bitcoins. This vulnerability, combined with the exchange's poor internal security practices and delayed reporting, created a perfect storm for exploitation. Users were unaware that the withdrawal system had a critical blind spot, placing their trust in a platform that seemed authoritative. The loophole functioned quietly for years, allowing hackers or potentially malicious insiders to siphon funds gradually without immediate detection. Each withdrawal appeared legitimate in system logs, creating a false sense of security for both the exchange and its users. It was a subtle, invisible vulnerability, one that could have been corrected early but went unnoticed due to insufficient audits and over-reliance on automated processes. This loophole would ultimately enable the loss of hundreds of thousands of Bitcoins, proving that even small technical oversights can have monumental consequences when billions of dollars are at stake. The timeline of the collapse. The exploitation of the loophole was not a single event but occurred over a period of several years. Between 2011 and 2014, attackers were able to manipulate transactions, moving Bitcoins incrementally to avoid detection. Each transaction appeared normal within the system, while internal audits failed to catch the anomaly in time. Early warning signs were ignored or misunderstood, and internal reporting mechanisms were either inadequate or ignored altogether. By early 2014, The scale of the losses had become impossible to conceal, forcing Gox to halt all withdrawals and declare insolvency. The news sent shockwaves throughout the cryptocurrency world, causing Bitcoin prices to plummet and shaking investor confidence globally. Social media, news outlets, and crypto forums were flooded with outrage, disbelief, and frantic speculation. Investors who had placed their life savings into Gox were faced with the devastating realization that a loophole in a trusted system could erase their wealth almost instantly. The human and market impact. The collapse of Gox had a profound impact on both investors and the broader market. Thousands of users lost their funds entirely, while others faced delayed recoveries that would take years to materialize. The event eroded trust in cryptocurrency exchanges worldwide, leading to a temporary decline in Bitcoin adoption and sharp price volatility. The human cost was immense, as early adopters and casual investors alike suffered financial losses that affected livelihoods and shattered confidence. Media coverage amplified the panic, emphasizing the fragility of digital assets and the risks inherent in storing wealth in unregulated platforms. The incident also highlighted the dangers of centralization within a system meant to operate on decentralization principles. While Bitcoin itself functions independently of intermediaries, reliance on centralized exchanges for storage and management created a single point of failure, exposing users to significant risk. Lessons for crypto investors and developers. The Gox case offers critical lessons for both developers and investors in the cryptocurrency space. For developers, it underscores the importance of secure transaction verification, robust internal controls, and continuous monitoring of system activity. The malleability bug went undetected for years, proving that even widely used platforms can contain hidden vulnerabilities. For investors, the incident highlights the importance of diversification, maintaining control over private keys, and remaining vigilant regarding platform security practices. Trusting a single platform with large sums of cryptocurrency is inherently risky. Additionally, the collapse illustrates that transparency and communication from exchanges are vital. Users must be informed of risks, delays, and potential security issues. The $450 million lost in the Gox collapse will forever remain a cautionary tale in cryptocurrency history. Investors learned that even dominant platforms are not immune to loopholes, mismanagement, or human oversight. To protect yourself, always diversify your holdings across multiple wallets and exchanges. Maintain strict control over private keys, monitor platform security updates, and stay informed about potential vulnerabilities. Never rely solely on the promises of a single platform, regardless of its reputation or size. If this story left you shocked, like this video, subscribe, and hit the notification bell. Comment below with your thoughts. How would you react if your life savings vanished due to a loophole in a trusted platform? This is Blockchain Black Holes, exposing the hidden risks of digital money, where technical flaws, human oversight, and misplaced trust can turn millions into permanent digital dust. Remember, in crypto, knowledge, vigilance, and preparation are your only reliable safeguards against disaster.